So the Fed cut interest rates yesterday, as you probably know. If you're interested in some of the nuances of what Jerome Powell mentioned in his speech yesterday, I'm going to go through that here now. So without further ado, let's just dive right in. So here's the transcript from Powell's speech. He points out that we don't have very good government data because of the shutdown. So the data looks similar from what we had in October, although the publicly available data we have shows that the labor market is cooling and inflation remains elevated. So, not an ideal situation for the Fed, but they felt that the risks to the employment market were greater than the risks of inflation continuing to rise. So, they cut interest rates by a quarter of a point. Wasn't a big surprise. But what is interesting is they are doing some things to improve liquidity in the markets. So they are initiating purchases of shorter term treasuries. I'll go into a little bit more detail on that. But he talks a little bit about GDP here. Economic activity expanding, consumer spending appears to have remained solid, but a good portion of that consumer spending is really being propped up by the wealthiest Americans. If you look at low income Americans, they've been spending less. Um, so not a good trend from that perspective, but for the time being, consumer spending is maintaining. Fixed investment continue to expand. A lot of that you could attribute to AI data center investment, and then activity in the housing sector remains weak. Not enough supply, prices are too high. I think I just saw that the median age for a home buyer is now 40 years old. So a very different picture from even a decade ago. GDP projected to be stronger than what they had originally projected in September. Layoffs and hiring remain low, but the unemployment rate edged up. Basically, if there was a big inflow of folks entering the job market, we would probably see unemployment rate go up significantly. The reason it stayed where it is there aren't really people entering the workforce. Folks aren't hiring, but they also haven't done massive layoffs. So we're in this interesting situation where everyone is kind of staying put where they are. If you look at folks who plan to leave their job in the next year, those numbers are way down. Most people are scared to leave because they don't know what the job market is going to look like if they try to go somewhere else. Um, so inflation, just really quickly, 2.8% higher than earlier in the year, which they're blaming tariffs on number. So they're targeting 2% still. They're effectively saying that once the tariff inflation goes away, inflation will go back to 2%. Um, I'm a little skeptical, but we'll see what happens there. Risks of inflation tilted to the upside, risks of employment to the downside. Challenging situation. He's been saying it for the past year. But what's new here is that Powell says the downside risks to employment have risen in recent months and the balance of risks has shifted. Basically, we've got a bigger issue if a bunch of people lose their jobs than we do if inflation ticks up. So they're prioritizing the job market to controlling inflation right now. Probably not a bad play, but we do run the risk of inflation continuing to creep up, which can cause repercussions down the road. Targets for the Fed funds rate remains the same for now. As I mentioned, they're putting any more cuts on hold until they have more data, but we'll have a clearer path forward at their next meeting. So here's something I wanted to point out that I mentioned earlier: implementation of monetary policy. There has been a tightening in money market interest rates. Basically, liquidity has been dropping in the financial markets. A lot of that can be attributed to the quantitative tightening that the Fed has done over the past couple of years. But basically, there's not as much cash as there used to be. They want to make sure that there's not a liquidity crisis in the market. So they're initiating purchases of shorter term treasury securities. And I just want to make a quick distinction here. The shorter term treasuries do not create additional liquidity in the market in the same way that quantitative easing does. When the Fed goes out and buys longer dated treasuries, they're doing that to put more liquidity in the market. But when they're doing this overnight repo, short term treasury buying, they're basically adding money and then pulling it back out. So the goal here is to maintain short term reserves. If there's ever a liquidity event where cash is needed quickly, there will be liquidity in the markets to do that. And then the other component of that is, this is interesting, the committee eliminated the aggregate limit on standing repo operations. So basically, what this means is when a bank overnight needs to have additional cash to make sure that they can fund outgoing funds and whatever transactions they have for the day, they can borrow from other banks or they can borrow from the Fed. The Fed did have a limit on the dollar amount of total repo that could be borrowed from them overnight. They've now eliminated that, basically saying if something goes wrong and banks need money quickly overnight, that full repo line is going to be available to them. And then just really quickly, here is a chart of the reserves for depository institutions over the past 6 years, starting in January of 2019. You'll see obviously big spike in COVID. We turned on the money printers and injected a lot of cash into the economy. You'll see that rise up until we had a huge inflation crisis. And then once we started with quantitative tightening, you'll see that kind of drifts down, and we're now at a point today where the Fed feels like there are not ample reserves for overnight liquidity in the markets. So that's what I have for you. Thanks for watching and have a good holiday season.